Good morning. Good morning, everyone. I'm Bagger Don at StockMarketCaddy.com. Today is January 20th at about 11 a.m. I wanted to explain to you how and why you might want to consider selling covered calls, or what some people call writing covered calls. This is an activity that you can do within an IRA account. Maybe you have a tax deferred IRA, or maybe you have a Roth IRA. The government will enable you, or they do enable you to do it within those accounts because it's a fairly conservative approach. And it can be like getting a dividend on steroids. Before we get started, let me just share with you again who I am and who I am not. I am not a broker. I am not a financial advisor. I am not suggesting to anyone to do anything with their money. I am a mentor. StockMarketCaddy.com is a mentoring service for those individuals who want to be diversified, not just in what they hold, but diversified in what they can do, in getting their money to work for them. So let's pick silver as an example because everyone is talking about silver. First, this symbol here, SI, at SI, is a futures contract. A futures contract. On a daily interval, if you had bought silver, a silver futures contract, which would have at the time cost you about $18,000, a leveraged product. 168 days ago, on May 21st of last year, at 35.12, you would be up 167% between the entry price and where it's trading at now at 93. But because it's a leverage product, your account would actually be up from 18,000 to $293,000. The power of leverage. So when you get really good and you understand the game and you get diversified in what you're capable of doing, you can really get your money to work for you. It isn't enough just to buy something and hold, not in today's world. But I wanted to talk to you about writing a covered call. Now, many people, or most people, when buying silver, they're not buying it in a futures contract. They're buying it in a ETF, exchange traded fund, and that ETF is symbol SLV. And we're going to change that interval to a daily as an example. And SLV on a daily basis also went long 168 days ago, virtually on the same day. Up percentage wise, maybe a little bit more on a percentage basis. Now, it says just $54, and you might be thinking, oh man, how boring is that, Bagger? Well, that is per share, per share. So we can come into this tool. By the way, this tool, SMC Swing Machine Plus, is a proprietary tool that we use and our members use day in and day out in trading futures and stocks and options, and it can do a whole lot of things, and we'll get into that on another video or two. We encourage you to visit the website. But let me come here, and I'm going to change. Let me see if I can move this. I'm going to change the inputs from futures. We're going to set that as false. And we're going to set it to stocks true. Now, the dollar, you can either put in a dollar amount, and in this case I'm going to put in 0, or you can put in the number of shares, because we have a member to Stock Market Caddy who bought 2,000 shares. And I'm going to show you in a minute what that will do. Now, they bought 2,000 shares, not on a daily interval, but was on a weekly interview down here at 22.23. 2,000 shares. Now, I'm going to lose the futures contract. If you don't mind, I'm going to delete it. This is what they did. Now, when they bought or invested in SLV at 22.23, on Swing Machine, it was down in here in panic sell. Nobody wanted to buy it. No. Today, everybody wants to buy silver. So they have seen their account grow from 1,000 shares would have been 22. So they would have put in about $45,000. Their account now is worth about $125,000. By the way, let's expand a couple of inputs so we can get the percentage return. Okay, so there is the return. Sorry about that. The actual return, so this is SLV, and they would have done this about 99 weeks ago, back in January, February, March 8th of 2024. Now, they didn't purchase silver with a futures contract. They purchased the ETF, SLV, and they did so when the price was at approximately 22.23. Now, the amount of money, I let you calculate that, $45,000, $50,000. Now, they currently have approximately $125,000. Now, looking at this tool, you can see that the panic sell that silver was in when they bought it is now no longer in panic sell. It's above its mean. Its mean is now 59.46 is the mean. And she is approaching, we call euphoria. Now, to save some room here, I'm going to hide this date, if you don't mind. And I am going to show you how to do a covered call. Bear with me here. I'm going to just come here and just make a little bit of room here so I can remove the date. We don't need to see that any longer. And you can see this column here in euphoria. When price starts to approach euphoria, that means that everybody and their brother is now interested in buying silver. That's not when we want to buy silver. See, we want to buy things when nobody else wants to buy them. Now, we might be thinking of selling, but geez, what if silver continues to run? It's possible, right? They can push it into euphoria, and it can stay in euphoria for a period of time. But the likelihood is eventually it will pull back. It may even pull back all the way to its mean. So what might a person do? When you have a market that is flat to up and you hold shares in that, you can go into the options market and you can do something called selling a covered call. And let me draw this out to show you what it looks like. So I'm going to draw a, whoops, that is not visible. We're going to get a green line. And we're going to draw this out graphically. So our member bought right here, and we're going to get, bear with me, we get our little writing pen together. They bought here SLV, and they bought it at, if you don't mind, I'm going to just use round numbers for right now, $22. And it is now selling for $85, as an example. And they're starting to think, geez, that's quite a bit of money. And their greed might be starting to kick in. We're normal. It's normal. We're all human. Do I take it all off? Do I sell a little of it? Well, there's a number of things that a person could do, right? When you have big profits like that, you could certainly take out your original investment. You could do that and then just let it run. You could trim a little bit as it approaches euphoria, or you can go into the options market and you can do something And I'm going to draw another little line, something called sell a covered call. And we're going to put a little line here, and I'm going to write this out. And I'm going to paint it red for a minute. Sell a covered call. And we're going to sell the covered call at the money. You have a choice on this, but I'm going to do it at the money. At 85. And I'm going to sell it the term for 40 days. 40 days. It's going to expire in 40 days. For selling a covered call, I will receive a credit. They're going to pay me some money for that. How much? Well, I just looked a moment ago. It's rather very generous because everybody wants to own silver right now. And the speculators are willing to pay up. See, a lot of the speculators don't hold the shares. They don't have the money. And they want to play with leveraged money. So what they're willing to do is they will pay our member $10. And I'm going to paint this today as an example. $10. Let me see if I can make a little more room here for it as an example. These are in round numbers now. And we're going to get a credit, $10. Now what happens is this. When you sell a covered call, and we did it at 85, if the price of silver is above $85 on day 41, and the person sold one covered call, that actually reflects, let me come back and put this in red here, it reflects 100 shares. A covered call is 100 shares, not 2,000 shares, just 100. So let me bear with me here. We'll kind of get this written in here. So it's 100 shares. That's the quantity we're talking about, 100 shares. And we'll just put it in parentheses. So the person said to their broker, or they said online, I want to sell a covered call at 85 for 40 days. You can specify, and the market will pay me $10 per share. And I have 100 shares, so it's $10 per share or $1,000. Now, the person who buys the covered call is buying the right to take 100 shares away from you at 85 for the next 40 days. Now, don't worry. They're not taking your money away. They just want the shares. So the way this would work, in scenario number 1, as an example, as we talk this through, in scenario number 1, let's say on day 40 or 41, SLV is trading at, let's say it's 120. Well, you will not have 2,000 shares. You'll only have 1,900 because these 100 shares will get called away from you at 85. That's how it'll happen, is the shares will go away, and in your brokerage account, you'll have $8,500 in cash. However, you will also still have the money that they paid you for the right to call those shares away. $10 a share or $1,000. So your net would be not $8,500, your net would be $9,500. So one way to look at that is if it's above, they get called away. It's kind of like losing. It's kind of like losing the shares not at 85, but at 95. Not bad, right? You kind of squeeze it out. So they could get, scenario one, they get called away and you keep the premium that they paid you. Now you can always come back at a later date and buy more shares and do this again, that's okay, right? And when you sell a covered call, you really do hope that it continues to go up. But you might be saying, but Don, it went to 100 and what did I say, 120, 125, and I would have done better if I just held it. Well, that is true. That is true. But you still have the other 1,900, right? This person would still have the other 1,900 shares, so it's kind of a high-class problem. Now, the other thing that can happen is what if, scenario number two, what if on day 41, what if the price is still at 85 or less? What if SLV doesn't go any higher? What if SLV stays right underneath 85? Well, in that case, you still got the shares. You would still have the shares and the premium that they paid you. That'd be pretty cool. Does that make sense? Because you see, they speculated and they would have come up like most of the time. Snake eyes. They didn't make any money. See, they have to get above that where they pay $10. They don't worry about what they got to do, but they got to get above actually 95 to get into the money to pay for that, and they got to do it as soon as possible. Don't concern yourself with it, but just stay concerned with what you're doing, right? So what happens is in your brokerage account, what I do want to explain to you is the way the brokerage account squares this up is they will continue to show you holding the full 2,000 shares, and your account will be doing this. Will be going up. But the covered call at 85, once you do that, right? Once you do that, it will be recognized in your brokerage as a short position, and it'll be showing that you're losing money as it goes up. But don't worry about that, because if you do the accounting, and once you've done one, you'll get a chance to see that, is remember, you may be losing the shares at 85, but you did get paid $10 per share, so it's kind of like losing them at 95, right? And I'll just put a little mark. I won't put a red mark. Well, I will put a little red marker in there. So it would be like losing them at 95, one way of thinking about it. But if SLV goes to, something higher, 120, 125, then yes, you won't get any of these profits. You'll be cut off. You made a decision, right? Now, the other situation is what happens, Don? What happens if, because we're approaching euphoria, the person pays me to take the shares at 85? What if they go to 75? Well, your account will go down $10, right? On all 2,000 shares, right? So you'll see your account value go from, whatever that math is, from 85 to down to, as an example, down to 75. But guess what happens to the call? He paid you $10 per share for the right to call the shares away from you at 85. He paid you $10 per share to call them away from you at 85. If the shares, right after he does that, if the shares go down, yes, your account will go down, but so doesn't the premium that he paid you. And guess what you can do? You can buy the covered call to close, the same one that you sold to him, and you buy it back to close for pennies on the dollar. Maybe you buy it back for just $1 when the shares fall down. And you get to keep the difference. That kind of cool. So another way to look at it is it's kind of like getting a little bit of insurance, because you're thinking, you know what, this thing is so extended, it's probably going to pull back. If I go into the options market and sell the sucker a call option at 85 and he pays me a big fat premium and the stock pulls back, then I can close them out pennies on the dollar and I get to keep that premium. Then it acts as a little bit of insurance, right? You can think of it that way. No, it's not on the whole thing. You're not doing it on the whole thing. So the third scenario down here is you could, there's actually more scenarios, but 3, you could buy, you can buy it at close anytime, but you really don't want to. Once you do the sell the covered call and it appears that you're losing money, you're really not when you do the math. But when you can close it back for pennies on the dollar, you could buy to close pennies on the dollar. Does that make sense? You could do that. And you get to keep them. And you see, when you sell the covered call, you really want to let it work, because the time element, this thing is expiring. And as it expires, the time is working against the speculator and is working in your favor. Because as the time decays, this money that he paid you is starting to accrue to you. Right? Not immediately, but as the days tick by, it begins to accrue to you. So don't be concerned when you sell the covered call that you see the covered call, what appears to be losing money. It's offset by the fact that your account is still, the brokerage still recognizes that you still have those shares, so your account's going up. But the description that I've just given you, if you watch it, you do one and watch it, you'll get a chance to see how it works out. But what is really nice is that if it does pull back and you can buy it for $1 and keep as 900, and then guess what? What if it then runs back up to 85? You can do it again and again and again and again. And if you're doing it within a retirement account and you, when you do your accounting, the money that you collect from the covered call, you start applying in an accounting fashion to your cost basis. This is the cost basis at 22. And you start applying those covered calls to the cost basis, which drops it down. You can literally get your cost basis down to 15, 10, and it can help you overall stay in a particular trade. Warren Buffett, none other than Warren Buffett, will say that, it's a fool's errand to try to time the market, and we don't agree, but that's okay. But he'll say that, you shouldn't try to sell anything. But Warren's not entirely truthful, because he does sell, not much, but what he does do, he does sell a ton of covered calls. Millions of dollars, maybe billions of dollars. It is a great way when you have a market that is flat to going up to do it. But when do you want to do it? Now, you could have done it down here. The person could have done it when they bought it at 22 and then sold the covered call at 23. But if they wouldn't be very happy if they only made a little bit of money, and then the thing, ran as it did up here. They would have left a ton of money on the table. But when you already have a ton of money made and you're pushing up in here to take a portion, just a tiny portion of a position to see the mechanism of how it is, it can be a nice way to go. And you can see it. And like I say, if something is in a tax deferred or tax free account, there's no tax impact. There's no, account, it's not a tax headache. And like I say, you can always come back and, put shares back on again. But if you get in the habit of doing this and you do this, every 30, 40 days, well, just think about it, it's entirely possible. You can you can do very well. That is the idea in the concept of selling a covered call. Selling a covered call. And like everything, you want to read up on it. You want to make sure that you have the shares. You understand why you're doing it. The reason why you're doing it, a person is just doing it on a portion of a bigger position when it's up in euphoria, approaching up in here. Now, if they're an active trader and they want to buy something in panic and they're afraid that it might go down still and they want to sell a covered call and just, extract it, you could certainly do that. But you don't want to be selling covered calls when something is dramatically selling off and going down, down, down. Then you could, it just wouldn't be. It's not, you still have an opportunity to close it and stay active, but it's more difficult to extract the income. Now, some people will do this. They'll say, well, you know what? I won't sell it at the money. I think SLV is going to 100. You could sell a covered call at 100. Now, they probably won't pay you $10. They might pay you $4, as an example. And if it never gets to 100, you keep the $4. If it pulls back even from 85, but if it pulls back, you can close them out pennies on the dollar. But if it gets to 100, then the person who paid you the $4 is going to call your shares away from 100. That they will do. But you get to keep the $4. So it's kind of like, well, for 100 of my shares, I sold them not at 100, but because I got the $4 from them, it would be kind of like selling it at 104. Not so bad, right? You get an extra 4%. That's would be the math on it. But you want to do it. You want to do it judiciously, not with full positions on everything, just around the edges, and understand why you're doing it. And what you're trying to do is extract a little bit of income over time, and you're putting time on your side. And because you have the money, because you have the shares, you are selling the right for someone else to take those shares away from you, and they're paying you for that. And you get to keep it. Isn't that sweet? Please read up on it. We go into great detail about further strategies about writing covered calls, selling covered calls, and how you can use tools like the Swing Machine Plus and other tools to help with the timing, right? Give it some thought. I wish everyone the best. If you got any questions, let us know. And for those members, and we have a number of members who have invested in silver below $25, they have done it with SLV, they have done it with futures contracts, and they are extremely happy. If you didn't, don't feel as though you missed anything. There's always opportunity. The most valuable commodity of all, it isn't silver, it isn't gold, it's time. You can't make it, you can't buy it, you can't trade it, but you can waste it. And we don't want to see you waste your time, and we certainly don't want to waste ours. Be sure to visit stockmarketcaddy.com. Be sure to read up on selling covered calls. But remember, please, the market that you're selling a covered call against, it must be flat to going up, not a market that's going down. And you want to understand what it is you're doing, and you want to stay very proportional, small, so that you can see how the brokerages report on it, and you get a chance over 30, 40 days to see and do the calculations to see what kind of a return. This is not aggressive trading. It isn't. It's passive working of your account and trying to add income. Have a great day, everybody. I'm Bagadon. This is StockMarketCaddy.com.